Welcome to today's explainer. We're jumping straight into the absolute roller coaster that is Erasca, a clinical stage precision oncology company trading under the ticker ERAS. If you follow biotech at all, you already know it's a space totally defined by wild swings based on clinical data and regulatory news. But Erasca, they've taken that to a whole new level recently. Let's unpack the science, the sudden legal drama, and the really complex financials driving this whiplash.
Let's kick things off with this jaw-dropping number. -48%. Just imagine waking up on April 28th and seeing nearly half the value of a major holding literally evaporate in a matter of hours. Over $2.8 billion in market cap, just gone in a single day. It was a brutal shock to the system for shareholders, for sure, and a really stark reminder of the inherent risks in clinical stage investing. But to truly understand why it fell so hard, we have to look at where it came from.
But here's where it gets kind of crazy. Look at the sheer paradox of this performance. Even with that catastrophic drop, the stock is still up over 200% year to date. But if you zoom in on just the last 3 months, down 22.6%. It's this wild collision of explosive long-term momentum just slamming into a brutal short-term crash. So how did we get here? Let's look at Section 1, targeting the RAS pathway and the clinical promise behind it. To understand the initial hype, the stock surged nearly 800% over the past year before the crash. We have to talk about ERA-0015. This is their lead product candidate, a pan-RAS molecular glue. The early data was showing incredible promise for targeting KRAS-driven non-small cell lung and pancreatic cancers. And the kicker? It showed robust efficacy alongside a highly favorable safety profile. We're talking mostly low-grade adverse events and absolutely no severe dose-limiting toxicities. In the oncology world, finding that balance is basically the holy grail. And Erasca wasn't just sitting on this monotherapy data. They aggressively capitalized on it. They locked in a major clinical trial collaboration with the pharmaceutical giant Merck to combine ERA-0015 with Keytruda. Plus, they secured a partnership with Tango Therapeutics. They even fast-tracked their monotherapy expansion cohorts ahead of schedule. Basically, everything was firing on all cylinders, validating the science and massively expanding the commercial potential. But of course, then comes Section 2, the billion-dollar patent war and the conflict that derailed everything. As you know, biotech investing is rarely a smooth ride, but man, things unraveled fast here. In early April, the company is riding high on positive clinical data. Then, late April hits. Competitor Revolution Medicines throws a massive wrench into the gears, demanding an immediate halt to ERAS-0015 sales and importation in the U.S. That is exactly what triggered that market panic on April 28th. By May, the fallout had spread, with multiple shareholder rights law firms launching investor investigations.
Now, maintaining a strictly impartial view here, we have to emphasize these are currently just allegations. Revolution Medicines is claiming patent infringement and trade secret misappropriation. But even though Erasca had previously reassured investors about their IP protection, these claims were serious enough to trigger immediate investigations by law firms like Pomerantz LLP, looking into whether Erasca actually misled its investors. The uncertainty alone was enough to vaporize billions in market value.
All right, let's step out of the courtroom and look at Section 3, financials and valuation metrics. Time for a reality check. Looking at the hard numbers, their net loss widened significantly. We're talking a jump from about $31 million in Q1 2025 to over $183 million in Q1 2026. The main culprit? A massive, one-time $150 million in-process R&D expense. They basically paid this to successfully exercise an option securing the worldwide rights to ERAS-0015 from Joyo Pharmaceutical. So yes, a massive hit to the balance sheet, but a highly strategic move to completely lock down their most valuable asset globally. The good news, though, they can actually afford it. Even with zero revenue right now and those widening losses, Erasca is sitting on a very healthy cash position of $408.5 million. They really padded this war chest with a highly successful, upsized public offering back in January. So why does that matter to us? Well, in clinical stage biotech, cash is literally oxygen. This $408.5 million is a vital safety net. It gives them the financial runway to fund operations and, crucially, push their ongoing clinical trials deep into the second half of 2028, all without needing to dilute shareholders further in the near term. But let's talk valuation, because this paints a bit of a cautionary tale.
Even after that massive crash, Erasca is trading at a price-to-book ratio of 9.5x. Compare that to the US biotech industry average, which sits right around 2.5x. What this tells us is that investors are paying a hefty, expensive premium for Erasca's accounting equity compared to its peers. The market is clearly still pricing in a lot of future growth and clinical success, which frankly leaves very little margin for error.
Which brings us to Section 4, Wall Street's divided verdict.
So, with incredible clinical promise on one side and severe legal threats, plus a premium valuation on the other, what is the smart money actually doing? Well, there's definitely some serious institutional confidence out there. Check this out. T. Rowe Price specifically named Erasca as a top relative contributor to their massive institutional small-cap stock fund in Q1. They highlighted that favorable safety profile and the lack of dose-limiting toxicities as huge drivers for their conviction.
However, the broader signals are completely mixed. You've got heavy hitters like RTW Investments absolutely pouring capital in, acquiring 16 million shares worth nearly $190 million. But at the very same time, company insiders are actively selling. And the analysts, they're scrambling to recalibrate across the board. Bank of America bumped them up to neutral, but slapped a modest $16 price target on it, stating the price now better reflects known risks. Meanwhile, Mizuho went the other way, dropping their target from $28 down to $26. It is the literal definition of a battleground stock right now. So I'll leave you with this final crucial question to chew on. Does Erasca's potentially revolutionary oncology science and that massive cash runway outweigh its complex legal threats and premium valuation? What's your key takeaway for navigating this kind of extreme volatility in clinical stage biotech? Thanks for tuning into this explainer, and definitely keep your eyes on the data.